Oh, it's 6.
Mm.
Hello!
Hello!
Imran, stand on your mark.
Oh, okay.
Okay.
Ready? Welcome back, everyone. Hello, welcome. Welcome back to In Your Best Interest, Malaysia. Give us a second. We have a little bit of a technical difficulty. It's okay. Okay, thank you, production. Okay, so we're back today, guys. We'll be talking about gold. And Ken, do you remember gold was the very first
all
topic
started
for
with
us. It
gold.
all started with gold, and now we're back again after 20 episodes
With silver as
with
well.
silver as well. So gold has, when we first talked about gold, it was at around $2,750 US dollars, and now it's at a record-breaking $3,000 per ounce.
So, you're welcome.
Yeah, well, I don't know.
Asked you to invest. We suggested.
We suggested.
Not financial
Not advice, not financial advice.
But nonetheless.
Yeah, it's just us
You're welcome.
talking. So it's up 15% since the start of the year already, gold, I mean. But here's the thing, right? You know, gold is always in the spotlight. Everyone's talking about gold. Everybody loves to talk about gold.
Yeah.
And for good reason, sure. But let's not overlook its shiny cousin, silver. Because silver always seems to be in second place, but you know, maybe that's just the way, because of the Olympics, right? You know, first place gold, second place silver. So that's what we'll be talking about today. But before we get into it, let me just introduce myself quickly. My name is Imran. I'm the financial writer here at Stashaway. If you read any of the weekly buzz letters, that's me.
And I'm Ken, the country manager of Stashaway Malaysia.
Yeah, so let's get into this precious metals rallies, because it's not just gold. Maybe we can talk a little bit about what are the drivers behind this sort of rally in the precious metals, and what can investors do about it? Right?
Yeah,
Why should we care?
I think in the backdrop there's always trade tensions. Ever since Trump was elected again, I think gold has shined again as the destination for safe haven destination, right? As an asset. When you have geopolitics the way it is, a very safe bet is to invest in gold. Underlying all of this also is this industrial use, scarcity, all of the fundamentals don't change. But I think what's driving the last 2 years' performance and this year's performance is geopolitics.
Yeah.
So, you know, it had a really good year last year, 27% up. And year to date, it's done, what is it? 15%.
Yeah.
And the long-term average, meaning like 20-year average, is something around 10.4. So you should always have anywhere between 5 to 10% of your portfolio into gold, which is what our general investing portfolios have anyway. So one theme we see underlying all of this is also not just normal investors, retail investors, or institutional investors, but central banks themselves.
Yes.
Big countries have been buying big positions in gold. Poland, we found out today, did some research, had bought last year 90 tons of gold. China 44 tons, India 51 tons, and Turkey also 50 tons. So all in all, central banks are buying up gold because maybe it's a preemptive move because of what Trump is doing.
Right.
And maybe it's in a way, kind of buying into something that's not the dollar or denominated in dollars. So that's why gold has done so well. And yeah, you were going to tell us about silver?
Yeah, so you know that's one of the drivers behind gold. Right? I think we spent the past 2 weeks talking about volatility and stuff like that. So one of the drivers is gold being a safe haven asset, right? But here's the thing, you know, silver is also considered to be a safe haven asset in some ways, not to the measure that gold is. But here's the thing about silver: it has also industrial uses, right? It has industrial applications. So, for example, for solar panels, you need silver. For electric vehicles, you also need silver. Fun fact, the average electric vehicle needs about 25 to 50 grams of silver, and that's twice the amount that you need for a conventional car.
So EVs have more silver.
EVs have more silver. I suppose it's the technology that goes into it. I'm not an engineer, so I don't know about that. So as the demand from technology increases, so does the demand for silver, right? Because silver is used in it. And also the other thing that's driving silver's performance, it's really this transition to clean energy as well, right?
Something about solar panels using
Solar panels, yeah, I said earlier, and then even besides even besides clean energy, it's also used in medical devices. So a lot of industrial applications. That's my point here, right? But the thing is, because it's also tied to industrial usage, the price of silver is tied to the economy, closer to the economy than gold, right? So if you can look at the historical performance of silver, usually it's like when it has a similar movement to gold because they're both have that safe haven status. But when the economy slows down, silver takes a deeper movement than gold. But when the economy goes up, silver's price goes up higher than gold, right? So it's more volatile. So that's the difference between gold and silver. But the question then is like, if you are an investor, right, and you're deciding, are you telling me, should I get gold or should I get silver? How do you think about this?
So if you look at the numbers, 20-year average for gold is 10.4, and then 20-year average for silver is around 8. So silver has a bit less of a return. It is more volatile.
Yeah.
So depending on what time period you look at or how long you're investing, silver could get you a higher return. There are years where it has done really tremendously well. But I think that if you're looking for diversification, having both is a good idea.
Yeah.
If you're just looking for an inflation hedge or a safe haven asset, then gold always wins out. But if you are thinking about adding to your portfolio, which is a little bit more future ready, right? Like you talked about all the new industrial uses in medical devices and EVs and things like that. I was listening to a Tesla all hands, I guess, presentation by Elon Musk, and he was talking about rolling out Optimus, the humanoid robots, and they probably have a lot of silver inside them as well.
Yeah.
So if you are a little bit more excited about the industrial uses of silver in the future, then that's where you would place your bet.
Yeah, and I think it doesn't have to be an either or decision. I mean, as Ken says, it's better for if you're looking for that diversification as well. And the thing is, you don't need to go to a goldsmith, right? You don't need to go to other silversmiths. You don't have to go to.
Really good point. Really good point.
You don't have to buy any sort of physical bars, right? So for example, on our platform, you can use our flexible portfolios, right? To invest in, we have a gold ETF and then we have a silver ETF, right? So you can just allocate as much as you want, adjust as much as you want. It's really up to you, but that's how you can invest in these metals without having to buy them physically, right? Okay, I think that's about it for gold and silver.
Okay.
Let's move on to our second segment, Real Talk. And Real Talk is the segment where I browse the internet, go to the Malaysian communities. This time, I went back to Malaysian PF, Malaysian Personal Finance, the subreddit. And I have here someone who is 26 years old. They have some cash saved, but they're looking to start investing. So they are earning quite a lot. They're earning around 15K per month, which is really great for their age. And they've already and they want to start with 15K. But they're wondering, how do you think about your investment exposure, right? Because also he has a housing loan, right? So how do you look at it as a holistic kind of thing, right, Ken? What do you think?
Yeah, I think first you need to see how you actually spend that money, right? Like I think if you have a mortgage and that takes around 3K, and then you have other more immediate needs, maybe you're paying for groceries, for your car, maybe all of the short-term needs, maybe you have a young family or something like that, or you're saving for something in the future. All of that maybe adds up to about 7K. Typically about 50% of your take-home pay is spent on immediate needs, including your mortgage. So with, let's say, around 5K left, especially after taxes and EPF, with 5K left, it's a really decent size investment that you can put away and think about your future. So because last week we talked a little bit about EPF and how balanced of a portfolio that EPF is, you as a working professional have a EPF very equally weighted between equities and bonds. You, as a young person, you probably want to take the decision to skew a little bit more aggressive outside of EPF, so that the overall portfolio is something that reflects the risk that you want to take, which is, you know, you're a younger guy, you're earning well, you want to take a little bit more risk. So something like an 80-20 portfolio is probably a good idea. 80% equities, 20% bonds. And if you are thinking about equity exposure, the MSCI World returned 10% over the last 10 years. The S&P has returned around 12.9 over the last 10 years. So that should give you a very good return above the mortgage rates of around 4%. So
historically,
right now you will be paying around 4% for your mortgage. So in that sense, you are probably better off investing for your future rather than putting any excess earnings into your mortgage. But I do believe in paying off your mortgage as soon as you can. So if you have any windfall gains from bonus or investment gains, let's say from which happen in a very short period of time, just putting it into your mortgage is probably a good idea, because at least you know that you have saved 4% per annum.
Right.
So and yeah, I forgot about crypto as well. If you're relatively young, you want to boost your risk reward of your portfolio. We spent some time talking about it, so go back and watch those prior episodes.
Yeah.
In those episodes we advocate not investing more than 5%.
Yes.
So crypto has a really good average annual performance, but as you know, with crypto, in a very short period of time you gain a lot, in a very short period you lose a lot, but it averages out to be a very, very good amount. So you have to look long term and not allocate anywhere more than 5%.
Yeah, and I think that's what I really like about our platform. Okay, I know this is a Stashaway show, but it's true, right? With something like our platform, you can easily invest in a core portfolio, like general investing, you know, that 80-20, right? As Ken was saying earlier. And then you want to add some crypto. Okay, sure. Now you can open a flexible portfolio and you can invest in a Bitcoin ETF on our platform, and you can see all of them there. You can manage all of your investments one shot, right, on one platform. You can manage your gold and silver as well, right? So it's just very convenient, right? Okay, Ken, thanks for that. And let's move on to our final segment for today, Ask Away. And similarly to last week, I went into our mailbag. I was digging around there for our client. These are real client questions, by the way. And I have one again, which is a little bit simple, but I think so fundamental, right? Our client asks, will my investments perform at the projected rate? Okay, so it's a fundamental question. And I think especially for those who are starting out or who are new to investing, of course you would wonder that, right? But I think to answer this sort of question, let's first define a few things, because it's not so easy to answer it straight up, right? I think the first thing is it depends on what investment it is in the first place, right, Ken? How would you answer this?
Yeah, I think if you are looking to invest, you always want to anchor your expectations onto some sort of return, right? I know everyone wants certainty, but I think you need to be a little bit more prepared so that you can get the answers that you want, so that you can take the right risk level. So when you talk about projected return or some sort of estimate of the return, right, there's two ways of looking at it. You can look back historically, or you can look at it in terms of a forward-looking projection.
Right.
Historical projections are easy. You can look at the asset class, see what it's done. Whenever we talk about the S&P 500, NASDAQ, these are all historical averages. We talked about gold, these are all average. So if let's say something performs above the average, you're like, okay, that's a really stellar year. If something is below, then it has a subpar year. Negative, it's a bad year. So historical is one easy way of looking at it. When you're thinking about the future, even the word projected means into the future. If you think about words like estimates or guidance, the fund manager is guiding you a certain rate. And that guidance is based on what the fund manager thinks is going to happen. Of course, it's an educated guess, but they will try and represent to you a certain rate, 7%, 8%.
Yeah.
And this is all forward-looking. So based on these forward-looking estimates or projections, it depends on what asset class we are talking about. If let's say you look at our Stashaway Simple portfolio, we project a certain rate. We project because we want you to know what you're getting for your cash in the immediate future. So we talk to the fund manager, we get a good estimate, and that is has quite a high confidence level because you're talking about placements into FDs to basically invest in, for your money market fund, which is the underlying engine of Simple. But when you're talking about an equity fund, or you're talking about a actively managed portfolio, let's say that another fund manager elsewhere is offering you, you have to be open to a range of possibilities. It could be up or down, and what you want to do is think of like, what is the reasonable range of possibilities? So let's say we talked about the S&P having on average around 12%.
Yeah.
The standard deviation, which is how much it could vary from the average performance, is 15%. So it's 12 plus 15 or 12 minus 15.
Right.
So it could be minus 3 or plus 27. So you know at least the range of possibilities that could happen. Because if you just ask, what is my projected return?
Yeah.
What is your guided return? And if, let's say, the unit trust agent just wants to give you a number for comfort, just says like, 8 to 10%. Then if, let's say, it doesn't perform 8 to 10%, let's say it performed 2%, you don't want to be the kind of investor who goes, you told me 8 to 10%. It's like you're asking to be lied to. So you should be educated in terms of what are the range of possibilities, have comfort that you are taking risks, and ultimately have some self-accountability as well. So asking all these questions, right, and putting all the onus on the fund manager or on Stashaway, you have a part to play. You should take some accountability, and if, let's say, you're educated, then you'll be open to, historical benchmarks or future possibilities.
Right. I think that was a very comprehensive answer, Ken. And so I have nothing to add. I think that was great. So that's it.
Speaking about future possibilities.
Yeah, speaking about range of possibilities, we have a little bit of time left over because I wanted to talk to you guys and update you guys on the show itself.
We're getting cancelled.
No, not yet. But next week we will be on Raya break, right?
Yes.
We won't be around next week Monday. By the way, Selamat Hari Raya to everyone.
Selamat Hari Raya, guys.
But we will be back to cover, on time, we'll be back to cover our monthly performance for the first quarter. So it'll be sometime...
March and first quarter.
So it'll be sometime in April because for our first quarter, we need to get the numbers from March, right? So it'll be sometime in April. That's when we'll be back for this show again. And then from then on, we'll probably be doing this on a monthly basis. So no more weekly shows, guys. I know. But it's okay because even though you'll see less of us, we will deliver more.
Wow.
In each show.
That's the promise.
That's a promise, guys.
But in the meantime, we also want to hear from you, right? What matters to you? What do you want us to cover? We've done quite a few episodes now.
Yes.
Which one did you like? I think there's just so much to cover. But whether we do it on a weekly or we do it on a monthly, we will deliver it to you so that you understand markets and stay invested.
Yeah. And maybe we'll be having some community polls. We'll get to know what you guys are thinking lah. Okay, I think that's about it. Keep an eye out though because we will be uploading shiny new reels that's based on our show. So to keep you occupied until our next show.
Yeah.
But yeah, that's about it, guys. So thank you all for watching, and we'll see you next month.
See you.
Bye bye.